for the first one, okay, you have. So for the first one, they told us that for the trading one, they told us that it had an original debit balance of 9,200. So adjustment for fair value adjustment for trading had a debit balance of 9,200. At the end of the year, it has an unrealized gain. So what does it mean? Remember, when you have a gain, what do you do with the gain? Sorry? You credit gain and you debit a fair value adjustment, right? If you remember, this was the journal entry when we had, this was a loss. So when we had the gain, like this one here, what did we do to fair value adjustment? We debited the account, right? We credited gain and we debited fair value adjustment. So when you have an unrealized gain, that's what you do. You credit unrealized gain, you debit fair value adjustment, okay? So here, we know that at the end, the balance is supposed to be 1,300. Because it's a gain, should it be? So it's a gain. So gain will be credited. 1,000. Basically, you think about it this way. So we have a gain. As a result, what happens to fair value adjustment? It's debited. Gain will be credited. So fair value adjustment will be on the credit side. Okay. So you know that the balance on the credit side will have to be 1,300. How do you get from 9,300 to 1,300? By crediting the account 7,900. This is the adjustment. Do you guys understand it now? I think it was basically that day. It was at the end of the lecture or something. No, it wasn't. It was in the middle. I don't know what happened. So for the second one, they are telling us that at the beginning it had a credit balance of 5,750. So 5,750. When we look at this one here, this is a gain again. It's a gain, so where does it go? The gain will be credited as a result. Well, here again we're looking at fair value adjustment. It's supposed to have a 2,600 debit balance because eventually it will be debited that amount. How do you get from a credit balance of 5,750 to 2,600? This is where you have to do the adjustment. And the adjustment in this case will be equal to the 8,000. Sorry, I put the wrong one. Sorry. The adjustment will have to be, in this case, the debit. A debit to fair value adjustment for the value of 8,350. Do you have any questions about that? It's just a regular adjustment. Okay? Okay, today we will talk about a big part of your final exam, which is what? Statement of cash flows. That's correct. And why do we need to talk about statement of cash flows? You see, so far, the whole semester we have been talking about what basis of accounting. What the basis of accounting? We have two bases of accounting that are usually used, that could be used. Accrual basis. So far we have been using accrual basis, which is required to be used on the GAAP. However, it does not tell the whole story. Remember when we talked once about when, for example, if the company has a lot of credit sales, but they suck at collecting. They don't do a good job at collecting that money. So they will end up with what? They have high revenues, right? They are selling. But they have, for example, say they had returns in the beginning of the next year or default in the next year. They might have a problem with cash. So you need to look at both sides of the story. First, you look at accrual basis because this is where you actually earn the money. But the payments that you will be making a lot of payments in cash. As a result, it is very important for creditors and investors and users to know also the cash position of the company. So, okay, it's good to know on an accrual basis how much the company earned. That's what? Eventually it will be net income, right? This is the difference between your revenues and expenses. But what if all your revenues were on credit, all your expenses were in cash, paid in cash? You will have a problem, right? To avoid this, or at least to explain that net income is really profits that the company is making, and it's not just a number where the company has a lot of revenues, but they don't have cash, which is to mean they cannot meet their obligations. What would happen, for example? Don't you need money to pay your employees? Employees will not accept for a long time, I owe you. You cannot tell your employees, I owe you. They need their salaries. Okay? Try doing that with the IRS. Good luck. You cannot do that. Your suppliers might wait for you the first time. The second time, they will refrain from sending you any products until you pay them. So this is why it's important to know what cash flows the company has. Cash flows are cash exchanges. So basically, cash inflows, those are cash receipts. They flow into the company's accounts. Cash outflows, they flow out. Those are the payments. So basically, cash inflows and cash outflows are simply cash payments and cash receipts. It's as simple as that. You use this information to validate your net income. So if you're saying that you had a net income of $5 million, okay, then the number in cash should also show that you had enough cash as well. You're not just selling on credit, you're also collecting them. So basically, the statement of cash flows provides this kind of information. It tells you whether the company's net income number is actually valid. It's not just any number. Okay? It gives it validity and credibility. So in this chapter, we will learn how to prepare the statement of cash flows. We will see how it looks like, and what we're doing in this chapter is we are going back now. It's like, think about as reverse engineering, we're going back from accrual basis to cash basis. Okay. So again, we've been talking about the usefulness of statement of cash flows, because why do people care about net income? Because it tells us the story it tells us what you can expect from the company the next year. This is the money that is generated from the company's operation. So this is sustainable. This is usually expected to be recurring every year, more or less, but at least it gives you an idea. So in order to predict or estimate the future of the future financial position of the company, statement of cash flow, it actually tells you basically it allows you to predict what the future cash flows will be. How much are you going to pay and how much are you going to receive in cash? A lot of people, they don't really like accrual basis because it includes a lot of estimation. We learned how to make a lot of estimations, right? So for example, collectibles and uncollected accounts. Remember those? When you had uncollected accounts receivable, that was an estimation under accrual basis. Remember we had bad debt expense and the allowance account, allowance for doubtful accounts, that was an estimation. It was never an exact number. You say that, okay, this is how much I believe will be. Depreciation, for example, this is not an actual thing. This is something that accountants invented a way to allocate costs. But there was no actual transaction on that. There was no actual transfer of cash on that day. The day you recognize the depreciation expense, there was nothing that was paid on that day specific. You're simply allocating the cost of a payment that happened in the past. So accrual basis accounting is very important to match expenses with revenues and to match revenues and expenses with the accounting period where they occurred. This is why revenues are recognized when the service is provided or the sale is made, and expenses are done when they are incurred. But again, there's the problem of cash. If you invest a lot this year, you might have trouble later on with cash, right? If you keep buying stuff. Even if you will depreciate that over 20 years, doesn't matter, you still have issues with cash. You might not be able to pay your debts, short-term debts and stuff like that. So you need to adjust from net income to net cash. This is what we will learn how to do, okay? In addition to that, the statement of cash flows, it tells you the story about, okay, we know that there were certain changes. For example, you know that the value or the amount of equipment has increased, but you do not really know why. Probably because you purchased additional equipment, but it does not tell you the details. It does not tell you, for example, that you also made some sales. You also sold some. The statement of cash flows, it tells you more about this. It tells you more details about basically what you sold and what you invested, etc. There are 3 sections. The statement of cash flows has 3 main sections. Those sections, they separate activities by time. So you have, the first one is operating activities. You always start with operating activities. Why? Operating activities are the ones that come from the business operations, right? And those are the numbers that are used to calculate what? The net income, right? The company's net income. You use the revenues and expenses mostly to get to net income. So this is the part, this is why operating activities adjust net income to net cash from operating activities. And this one, it uses all the accounts that are, basically the accounts that are on the income statement. Investing activities are, as the word said, those are when the company invests in bonds. And here we're talking about investing in, for example, someone else's bonds or stocks. You remember the chapter before where they invested in company XYZ's stocks? This is the investment. And it includes cash outflows and cash inflows. So cash outflows will be when the company purchases those stocks, because they will have to pay cash. And then you have cash inflows. This is when the company actually sells those stocks. We'll talk in detail about each section. I'm just trying to explain what we're looking at here. Okay? Another kind of investment is when the company invests in new equipment. They are paying for new equipment. This is cash outflow. Or when they sell an old truck. This is cash inflow. The last part is financing activities. This is when the company issues their own stocks or their own bonds. So let's see how these are done. So the second one, like we said, operating activities, you're looking at the elements of the income statement, revenues and expenses. In the investing activities, you're looking at changes. And here you're looking at changes because you had previously investment. So you need to look at how did this change. Did you have more investments? That means you invested more this year. If you have less investments, so if equipment was $100,000 last year, this year it's 120,000. That means at least that you invested 20,000. Let's keep it simple. You did not sell any equipment. You just purchased a new truck. So basically that is a cash outflow because you invested additional things. So you look at the change in investments and long-term assets. Those are the things that you are investing in them. The last thing is financing activities. Here you're looking at the bonds that the company issued, the change in the value of bonds that the company issued, which is the change in long-term liabilities, right? You also have to look at the change in equity, which is what? In this case, when we talk about financing, the company issuing bonds and stocks, right? This is when the company issues bonds and stocks. So you look at long-term liabilities and you look at equity. Let's see how this is done. Under operating activities, this shows you the cash inflows and cash outflows from operating activities. So cash inflows are cash receipts. When does the company receive cash? Now don't think about it from an accrual basis. Think about it in terms of cash. When does the company receive cash? Sorry? When they sell something or they provide a service, right? Or when they earn, yes? Go ahead. Yes, interest revenue. Basically when they earn interest or dividends. This is how a company makes money. How do they make money? They make money by, this is how they receive cash. They receive cash when they are investing in company XYZ stock, and the company distributes cash dividends. If they pay them cash dividends, it will be cash dividend. As a result, this is cash inflow, right? If they have bonds, if they invest in bonds, every 6 months they will receive an interest payment. That payment is in cash. It is a cash inflow. And of course, when the company provides a service or sells a product. This is cash inflows. Cash outflows. Again, this is what? Think about it. When does Best Buy pay cash? Yes? When they buy inventory. Basically, cash outflows that go to their suppliers. Right? So you have cash flow that goes to suppliers. What else? Yes?
Pay the employees.
Pay their employees. So cash paid to their employees. What else? But they pay interest? Yes, but this is not operating. Interest, think about it. Interest that is related to what? Okay. Now, don't get confused. But yes, actually yes. When they actually pay interest for bonds that they have, when they pay interest for bonds that they have invested in, they have not bond. When they pay interest for bonds that they have issued, yes. Don't get mixed up between this one and when they actually and the actual bonds. The actual bonds are financing. Interest, expense. This is an interest expense. When you remember the word expense, this is an income statement item, and usually this is part of the operating activities. So I think I misheard in the first one. So we're talking about interest that they pay on bonds that they have issued. So this is a cash outflow. Interest that they receive, this is a cash inflow. Okay? This is what interest revenue, that's a cash inflow. Interest expense, that's a cash outflow. Okay, so this is when they pay to the people who purchase their bonds. Okay? Now, you also have taxes. So you have different items that will be considered as cash outflows. Think about it. Which ones are on the income statement? Which items are on the income statement? Those are the expenses. Those will be cash outflows. Okay? Cash outflows could be, for example, what? Utilities, rent. So all these are cash outflows, and they are from operating activities. This is from operating activities. Remember, you look at the items from the income statement. So you have interest, that comes from issuing interest expense that the company is paying because they borrowed money, so they are paying their creditors. Okay? The payment of the actual loan, that's not an operating activity, that's a financing activity. This is when they borrow money and then they pay it back. So we'll see in a second. When you look at investing activities, you look at the purchase. If you're talking about cash inflows, this is when the company is selling a building or equipment. So this is the sale of PP&E. On the other hand, buying PP&E, it will be considered as cash outflow. So those two would be basically, those two are the opposite to each other. One of them is when the company buys equipment, that will be cash outflow. The other one is when the company sells equipment or building or basically PP&E, that will be cash inflow. Okay? The other one is sale of investments in debt or equity. This is when the company is selling bonds and stocks. When they invest in bonds and stocks of other companies, they will be paying in cash and they buy the bonds. Those are, in this case, they are paying in cash. As a result of the purchase of stocks or bonds of other companies, this is cash outflow. When they sell them, it would be cash inflow. Okay? You also have the collection of a principal. This is the collection of a bond, but the principal amount, not the interest. We said that the interest expense is part of, the interest revenue is part of the operating activities. This is when the company is receiving a loan, is receiving the money that they lend to another company. So when they receive the principal amount that they lend to someone else. When they give a loan to someone else, this is when they will be paying cash. So this is the cash outflow. Again, those are opposite to each other. So those are the two sides of the story of each one of them. You either buy or sell PP&E, either buy or sell bond, basically debt and stock investments. And the last one would be either give a loan or you take it, you get paid back. This is the part that talks about investing activities. Financing activities. Now, financing activities is very simple. This is when the company issues stocks or bonds, their own stocks or their own bonds. Okay? When the company sells stock or they sell bonds. So when they issue bonds or when they issue stocks. Then what do? They issue bonds or stocks. What do they get in return? Cash. So this is cash inflows. When the company redeem long-term debts, when they buy back those bonds, they are paying in cash. When they buy treasury stocks, they pay in cash. So those are cash outflows. Now there's here one more thing, which is when the company pays dividends. Remember, dividends are not expenses. This is why dividend does not go on the income statement, right? Remember that. Dividend revenue will go on the income statement. As a result, dividend revenue, when the company receives dividend, this is part of operating activities. When the company pays dividends or distributes dividends to their stockholders, this will go as part of the financing activities. Any questions about this? Yes?
So when you're saying like investing activities, when you're saying investments in debt or equity, is that like when you're selling, like when companies sell their
What? No. This is different. That was a sale of assets. We're not talking about that. This is different.
So what's different? What makes them different than finance using common stock and bonds? Like what are investments in that or equities?
Let's say that you issue a bond for 20 years.
Oh, okay. So
This is financing if you issue your bond. But let's say that you invest in Best Buy's stocks. Now you're making an investment. Think about it from the point of view of the company. What's the company doing? Are they issuing bonds, which is mean are they taking a loan? In this case, they will be getting cash, right? And in this case, those bonds will be financing. They are raising money. They want to finance a new building, so they either borrow money or they bring in new investors through issuing stocks. This is when the company is doing what? Financing. But on the other hand, when the company is investing, they are simply putting their cash in new truck or a new stock or securities portfolio that they purchased. Any questions? In addition to that, the statement of cash flows will include certain significant non-cash transactions because those they might have a material effect, a significant effect on the company's financial position. So they would want to disclose that just as part of full disclosure. Okay, so in this case, for example, let's say that the company purchased a land, but rather than paying in cash, they issued stocks to purchase that land or issued bonds to purchase that land. You still need, even if the company did not pay cash, it makes sense to include it. However, the company does not include it in one of those three sections because this is a non-cash transaction. What they do is they include it at the end, at the bottom. They can either include it as a separate schedule, okay, that will be at the bottom of the statement, or sometimes they just put it in the notes of to the financial statements. They add it to the notes of the financial statements. Okay? But as far as you are concerned, you're supposed to do it at the end for the homework, at the bottom of the statement of cash flows. Okay? Sometimes also there's the conversion of bonds to stocks. This is a significant thing. You're increasing. You're converting part of your part of your liabilities. You're converting them to common stock. Okay? So all these things have to be mentioned in the as a note at the bottom, or at the bottom, for example, of the statement of cash flows. This is an example of statement of cash flows. You always start with basically, later on we will start with net income. This one, it will show you cash flows from operating activities. That is just a summary. It's not the individual item. We'll see later on how we'll list the individual items. But basically, you have the three categories. You have cash flows from operating activities, from investing activities, and from financing activities. After that, you have, after each one of them, you have net cash provided by or used by, because it could be net cash that was used by operating activities, right? If you had more cash outflows than cash inflows, you have cash used by operating activities. If you have more cash inflows than cash outflows, then you have net cash provided by operating activities. You have net cash provided by operating activities, net cash provided by investing activities, and by financing activities. And then you calculate net increase or net change. So it could be net increase or net decrease in cash. You compare this amount to the change from a balance sheet. Change in your cash account. So you have the verification method. This is the nice thing about the statement of cash flows. You have the verification method. You look at the end. You look at your net change in cash. Is it equal to the net change in cash, in the cash account, in the balance of the cash account between this year's balance sheet and last year? They must be the same. Because at the end, those are the same transactions. You just You're just doing different calculations. But eventually, this is the same cash that the company has. This is whatever you have in your bank. So this is what you need to actually compare. You compare net change in cash to basically the change in cash on the balance sheet. So this is why you have here cash at the beginning of the period plus the net cash. It should give you cash at the end of the period. This is the same amount that should appear on the balance sheet of that year. Okay, and at the end, at the bottom here, you have non-cash significant transactions. Okay? There are two ways of doing financial statements, doing the statement of cash flows. The first one is the direct method, the second is the indirect method. Both are acceptable, but you have like 98% of the companies they use the indirect method. So this is what we will focus on. I will cover later on the direct method, but it will not be included in the exam. The direct method, I'm just including it so that you would understand what we mean by it. Conceptually speaking, and the FASB and academics, for example, they prefer the direct method because it's conceptually it's more solid. It makes more sense. However, in practice, companies they prefer to use the indirect method because it's simpler, easier, and much more practical to use. With the direct method or the indirect method, the only section that is affected is the operating activities. Investing activities and financing activities are done the same under both methods. The only thing that will change is operating activities. Now, operating activities under the indirect method, you start with net income, and then you begin with net income, and then you start adjusting to get to net cash. On the other hand, with the direct method, you start looking at cash inflows and cash outflows specifically, directly. Okay? So here we need to classify each of these transactions by type of activity. You have the company issued 100,000 shares of $5 par value common stock for $800,000 in cash. Think about it. The company is issuing stocks. Financing activities, okay? The company borrowed $200,000, signing 5-year note bearing 8% interest. So the company is borrowing money. Finance, right? Company is borrowing money. They are issuing their own bonds. In this case, their own note. They are signing a note. Purchased 2 semi-trailer trucks for $170,000 in cash. Investment. The company is investing in 2 trucks. The company paid their employees' salaries. Operating activities. This is salaries and wages expense, right? What about the last one? Collected $20,000 cash for services performed. Operating activities. That's service revenue, right? So you started to get the hang of it. Just don't get mixed up between investments and financing. Don't get mixed up between interest expense and interest revenue on one side, which are operating activities, and interest and dividends. Basically, dividends that the company receives as revenue, operating activity, and dividend that the company is paying to their shareholders. Okay? Don't get mixed up between bonds that the company is investing in and bonds that the company is issuing. One of them, they are the opposite. One of them is when the company is borrowing money. The other one is when the company is lending money in return of interest, right? So this is what you need to keep that in mind. In order to prepare the statement of cash flows, we need 3 main sources of information. you need what we call the comparative balance sheet. This is the balance sheet of this year and the balance sheet of last year. Why do we need that? Yes. Yes, one of them is cash. So you need to compare the changes in those accounts. If you want to see, how would you know that the company invested in truck, in equipment? By looking at last year's balance and this year's balance. This will give you an idea of what changes happened. If you had a change in common stock, what does it mean? That the company issued, for example, common stock or bought treasury stock. So basically it depends on the change. But those comparative balance sheets will give you an idea of the changes in those accounts. This is the first source of information. The second one is, of course, your income statement. This is where you're starting from. Because remember that the income statement will give you an idea about different expenses and different revenues that are listed there. Plus, it gives you something very important. It gives you your starting point, which is net income or net loss. So it will give you starting point, which is net income. This is the number that you will start from, and then you will reverse it until you get to net cash instead of net income. Remember, the idea here is to go back from accrual basis to cash basis. The last one is you need some additional information sometimes. This additional information will include, like for example, issuing. It tells you, for example, that there was a sale of assets. Remember that if you had an increase in equipment, you only can say that you assume that this is from purchase of equipment. However, there might also be another thing, which is a sale of those other trucks. So you sold one truck, you purchased 3. The net change would be 2 trucks, something like that. I'm just giving this as an example. Okay, so you purchased new trucks for $50,000. You sold one truck for $10,000. The net change will be $40,000. But you still need some information about what changes happened. You need, for example, to know about depreciation, etc. So let's see how this is done. So remember, you need 3 sources of information. You have 3 sections. Operating activities. Then you have investing activities. And finally, you have financing activities. Okay? Now, there are 3 major steps in preparing the statement of cash flows. The first one is where you look at the operating activities. This is when you're trying to convert net income to net cash from operating activities. So what do you need to do? You have to adjust those expenses, and you have to adjust the net income by looking at, for example, all the non-cash expenses that were included. For example, depreciation expense. Did the company actually make any cash payments? But by including depreciation expense on the income statement, what happened to your net income? It decreased, right? It went down. So as a result, you need to adjust for that. You need to say, okay, so this negative number, which is the depreciation expense, I need to remove it before it actually affects net income. As a result, what do you need to do? You have to put it back in. So you need to remove this payment as a result to the net income. So let's say that, we'll do that anyways in a second, but just bear with me for a second. So what you need to do is you need to adjust for it by saying that, okay, this payment, this expense that was not actually paid in cash, it decreased net income. It should not have increased under the cash basis. It would not have decreased your income, right? So net cash should not have decreased. Okay, this is the first one. You analyze the company's balance sheets to see the differences in expenses, the differences in certain accounts, mostly non-cash current assets, like for example, accounts receivable, accounts payable. You look at accumulated depreciation sometimes. So you look at all these accounts to see which ones, because remember, those will reflect also some expenses. So if you look at inventory, what's the other side of inventory? So what's the other account that is always related to inventory? When we talk about inventory, we also talk about cost of goods sold, right? So when we think about inventory, we're also thinking about the cost of goods sold, which was recognized. Remember, the cost of goods sold is only recognized because of the matching principle. We only recognize cost of goods sold when the company is selling a product. They sell the product, they recognize the revenue and the cost and the expense. So revenue and expense. So they will recognize the sales revenue and the cost of goods sold. But in reality, this may not be the same time that the company purchased a lot of inventory this year. They are not going to recognize it. It will be sitting there as inventory because they haven't sold it yet. But think about it now in cash. Did the company pay for those? Yes, they paid for those. So we need to adjust for this. So the first step is to do the operating activities section. Second one is where we analyze the changes in equity and long-term investments, long-term liabilities. So you look at those ones, and then you look at basically to prepare the investing and financing activities sections. Now we have prepared the 3 sections. The third step is where you actually look at the net change in cash. So this is whether it was a net increase or net decrease in cash. You look at it and you compare that change to the change in the cash balance on the balance sheets. That's a nice thing because it gives you an idea and it gives you a way to calculate and to see whether, basically to verify that you've done it correctly. Because if you have a net change in cash that does not equal the net change in the cash balance on the balance sheet, that means you made a mistake. You can go back and try to find it out. Okay? Like I said, people prefer companies, the majority of companies that prefer the indirect method because it is more practical, it's easier, simpler to do, and this is what companies, and it works, so companies, they like it. Academics, from conceptual perspective, they prefer the direct method, and even the FASB, they would encourage companies to use the direct method, but because it's more complicated, it's much less in use. So we will focus on the indirect method. Okay? Now, for the indirect method, again, remember you always start with the income statement and the comparative balance sheets. The income statement will give you the net income. This is the number that we will start with. This is the number that we need to adjust. And then you also have comparative balance sheets. You have from this year, previous year, and then you have the change. I recommend that you do the same thing in the exam. So you will be given, let's say 2015 and 2014. I recommend that you do the same thing. You say that, okay, I have an increase in accounts receivable. I have a decrease in accounts payable, something like that. So you do the same thing as we have here. You have a decrease of 10,000, and then you start adjusting for these. You do that for all the accounts and the balance sheets. Okay, as you can see, it's the whole thing. And then you also have additional information. Examples of additional information are like this. You have depreciation expense was made up of 6,000 for buildings and 3,000 for equipment. The company sold equipment with a book value of 7,000 Okay? For 4,000. We used to record gains and losses, right? But gains and losses are not really, how to say that? They are not real in that. When you think about it as cash, what do you have? You don't have something that's called gain. You have cash inflow and cash outflow. When it comes to, for example, the sale of equipment, you have cash inflow. How much did you get? Look at it. How much did you get? 4,000. You sold it for 4,000 in cash, right? So this is the amount that you paid, that you received when you sold that equipment. This is cash inflow. Okay, what about cash outflow? The company originally purchased it for how much? No, 8,000. This is not the number. The company actually paid 8,000. You automatically know that the difference is gain or loss. Here you're not talking here about gains or losses. What you're talking about is actually how much you received, how much you paid here. Whenever you get confused, take a step back and look at it. So what did the company do? The company purchased it. Is it for 7,000 or 8,000? Think about it. How much did the company pay? 8,000. So this is cash outflow. When the company sold the truck, how much did they receive in cash? 4,000. This is the amount that was received. Period. This is the cash inflow. You have also, for example, the company issued $110,000 of long-term bonds in direct exchange for land. So they are buying a land, but they are not paying in cash. This is a significant non-cash activity. Remember those ones? So this one will not go on the body in the body of the statement. It will go at the bottom as a separate schedule. You say that okay, the company purchased a land. This is a big event. It's a significant event, but they didn't pay cash in it. You have to know that because in this case, the change in bonds was not for cash. The change in bonds was due to the purchase of a land. Later on, you have, for example, the company, a building costing $120,000 was purchased for cash. The company invested in a building. The company paid cash $120,000. Here, we don't really care about depreciation. The company paid that amount, that's cash outflow. Here. Equipment costing $45,000 was purchased. This is another investment. Again, this is a cash outflow. Do we care about depreciation here? No, we don't. We're talking about cash. What cash came to the company? Where did it go? Period. And then here you have also, we issued common stock for cash. The company is financing. They issued stocks for 20,000 cash. The company declared and paid the 29,000 cash dividends. They paid 29,000 in cash dividends. So that also should affect the net cash of the company. So let's start doing that one by one. Operating activities. First thing you need to do is you look at net income. Again, you start with net income or net loss. So you start with that number. Then you add any non-cash expenses. Those are expenses that the company recognized as an expense, but they have not actually made the payment. Like, for example, depletion expense, amortization, depreciation expense. All these ones, those are expenses that are more or less artificial expenses. The company recognized them simply to match revenues with expenses, to allocate the cost of a truck over its useful life. But the payment was made only at the beginning when the company purchased that truck. The company is not making a payment at the end of every year for the amount of depreciation, right? So we have to go back to cash. You recognize those expenses, you said that those expenses decrease your net income, but they should not have it decreased. As a result, you add them back. Okay? The same thing could be said about gains and losses. So gains and losses from financing and investing, when the company buys a stock and sells it back and they make a gain, or they record a gain or loss, the actual gain or loss is not cash. The cash inflows and outflows are the actual amounts that the company paid for the stocks or what the company received for those stocks. Period. What the company paid for that truck is cash outflow. The company received when they sold that truck is cash inflow. Period. So what do? If you have gains, you have to remove the gains. Think about it as they have overstated your net cash. They increased your net income. But gains have to be removed because they are not part of operating activities. They are automatically included when you later on calculate, and when we do later on what? Investing activities or financing activities. As a result, you have to deduct or subtract gains and losses which have decreased your net income. They should not have under the cash basis. So what do? You put them back. You add those losses and you subtract gains. And finally, you analyze non-cash current assets like inventory and accounts receivable. Okay, and then you also look at non-cash current liabilities such as accounts payable. You see the difference between the two, and we will see now. We will do one by one. So let's do this one. Oh, by the way, just as a reminder, I posted yesterday the survey for those of you who did not read my email. First of all, shame on you if you did not. If you for any reasons, a valid reason you did not see the email, I already posted the surveys on Blackboard. Okay. I'll take your word for it. So this is just Steve's mention to fill out those surveys. They're not going to take a long time. Because I think for the search report, you only have until December 9th. That's like 5 days from now. So what was it? Okay. So an example of cash flows from operating activities is payment of cash to lenders for interest. So this is a payment of interest. Receipt of cash from sales of capital stock, this is what? Sale of capital stock, this is when the company issued their own stock, which is financing. Payment of cash dividends, again, this is part of when the company pays their shareholders. It affects, this is part of financing. And none of the above is part of none of the above. So, depreciation expense. Now again we're doing operating activities. Depreciation expense, and by the way, amortization expense and depreciation expense are treated similarly. So you have here, we know that it has decreased net income, it should not have. So what do? You add it back. That's a virtual expense. It was a non-cash expense. It was an expense recognized by the company, but it was not paid in cash. As a result, we have to, when we think about it in cash, it did not happen. You have to remove it. How do you remove it? You add it back. So you add this amount. Again, for the statement of cash flows, you start with, you have 3 sections. The first one is cash flows from operating activities. This is the section. This is your starting point, net income. After that, you have this sentence, adjustments to reconcile net income to net cash. Basically, to go from net income to net cash. Okay? But because here we're looking only at operating activities, you specify that those are the adjustments to go from to reconcile net income to net cash from operating activities. Makes sense, right? First one is you add non-cash expenses, depreciation, amortization, depletion, etc. The next one is loss on disposal of equipment. And again, we said that this is, again, another virtual thing about it. A gain or a loss would be a virtual expense or revenue. They are not revenues and expenses, but let's think about them this way in this case, just for a second. Those are virtual. Why? Because in this case, we're looking at it as cash. Did the company receive cash as a gain? Or did they receive cash for the sale of a truck? They received cash for the sale of the truck, right? No one gave them money and told them that, okay, so this is your gain. They're not going to do that. They'll give you, okay, so this is for your truck. And when the company buys a building or truck, they will pay money to the car dealer. They will give them, tell them, okay, so this is the money, this is the price of your truck. The difference is a gain or a loss. But no, there is not. No one will tell you that, okay, this is the money for your gain and this is the money for your loss. Okay? Under the accrual basis, we recorded that as gain or loss. On the cash basis, we have to adjust for it. So what do? When you have a loss, it has decreased. It's like an expense, right? So it has decreased your net income. But because this is part of investing or financing, depending on what you're selling and buying, so this is part. This part will have to be, if it's a loss, it has to be added back. If it is a gain, it has to be subtracted from. It has to be subtracted from net income. So here we have a loss, so we add it back. Okay? When you have a change to non-cash current assets. So this is here, think about it as accounts receivable. Accounts receivable, if in the first year, if in 2014, the balance in your accounts receivable were 100,000. In 2015, the balance of accounts receivable was 120,000. What does it mean? So actually, let me put it this way. So in 2014, the balance was 100,000. In 2015, the balance was 90,000. Assume that during 2015, the company sold all their sales were in cash. What do you think of this one? Basically, the company collected $10,000 from their customers. The customers used to owe them 100,000. Now they owe them 90,000, right? Which is to mean the company received more cash than they actually recognized as revenue. They received all the cash from this year plus 10,000 from previous years, from debts that customers owed them in the past. So what happens in this case? You have more cash. The company received more cash than they actually recognized. So what do you need to do? You need to add those $10,000 to cash, right? Now this is what? This is a decrease in accounts receivable. This is a decrease of what the company what the company's customers owed them. The customers owed originally 100,000, and now they owe them 10,000 less. That means they paid 10,000 out of that. So you add the decrease in accounts receivable will be added. Okay? Take this example here. The balance from last year was 30,000. From this year it is 20,000. During the year, the company made sales, credit sales for 507,000. This is your credit sales revenue. Those are the revenues from credit sales. What does it mean? That means that during this year, the company received cash collected 517,000. But the company recorded as revenues 507. So under the accrual basis, revenues were 507,000. Those are the revenues from this year. Under the cash basis, the company's cash revenues, cash inflows were 517. So this difference of 10,000 will have to be added. This example is a decrease in accounts receivable. Okay? So when you have a decrease in accounts receivable, you add it. So you add the decrease in accounts receivable. If you have an increase in accounts receivable, that means that the company this year recorded those revenues, however, they did not collect all of them. As a result, they received less cash than they actually recorded as revenues, and this increase in accounts receivable will have to be deducted. Another example, so this is what you do. You have an increase, you had in this example a decrease in accounts receivable, it will be added to net income. Another example is inventory, and I think someone mentioned it before, inventory here. So what happens when you buy inventory? Let's say that the company purchased inventory, they bought $100,000 of inventory, and they sold the whole thing. In this case, the cost will be the same as the cost of goods sold, right? The cash cost, when you think about it from a cash perspective, the amount paid, the cost, will be equal to the cost of goods sold. But let's say, like in this example, the balance originally was $10,000. The company, during the year, they bought $155,000. The company recorded cost of goods sold. Those are the ones that were sold as $150,000. How much did the company actually pay in cash? Sorry? The company actually paid $155,000. Those are the ones that were actually paid. Those are the ones that are actually paid in cash. Not the cost of goods sold. The cost of goods sold is the expense that is recognized. The purchases are the amount that the company actually paid in cash during that year. Now, how do you calculate purchases? Remember, you have beginning balance plus purchases, right? It will equal to what? Cost of goods available for sale. Cost of goods available for sale is equal to what? Cost of goods sold plus ending balance. Seriously? Come on, guys. That's inventory. I wish I could say inventory 101. That's even less basic than that. Remember that? Beginning balance, you add purchases, you subtract the ones that you sold, that will give you ending balance. So in order to calculate purchases, this is the amount that was paid. Purchases will be equal to what? Ending balance minus beginning balance. This is the change in inventory, right? This is the change in the balances of inventory. And then you add cost of goods sold. This is the amount that was paid in cash. Okay? So in this case, we had an increase in inventory. So what do? You have an increase in inventory, you subtract it. That means you sold less than you actually purchased. You recognize cost of goods sold for inventory less than the actual cost of inventory that you paid in cash. So you subtract the decrease in inventory, and if we had the increase in inventory, and if we had a decrease in inventory, that means you actually sold more than you purchased. In this case, you have to add it. So increase in inventory is subtracted. Changes again to non-cash current assets. Prepaid expenses. This is, for example, when the company purchases insurance. The company is buying insurance policy for 1 year. As far as cash is concerned, the company paid the whole amount now. Right? So what do you need to do? Prepaid expenses are again non-cash. So what do you do? Non-cash assets. So what do you do? If you have an increase in prepaid expenses, that means that the company purchased a new policy. So you add it. I'm sorry, the company. So you have to consider that as cash outflow. So you subtract it from net income. The company purchased a new policy, paid it in cash. Okay, cash outflow. That will decrease your net income. So you subtract it from net income. If you have, on the other hand, a decrease in prepaid insurance, that means you recognized insurance expense, for example, although you did not make any payment in cash. So this will have to be added back. You add the decrease in prepaid expenses. Here we have an increase in prepaid expenses. So what do? You subtract this increase in prepaid expenses. Now we look at current liabilities. Okay? Remember, current liabilities are the other side of current assets in the way they behave. So now let's say that you have more accounts payable. What does it mean? Your accounts payable increased. That means you purchased, for example, additional inventory, but you did not pay for it. Right? So you recognized that, but you did not actually pay it in cash. So when you have an increase in current liabilities, that means you have additional debts, right? Additional liabilities. That means you recognize that amount. So for example, for accounts payable, you need to add this increase. So you have more liabilities. That means this amount, you recorded it as a payment, but it was not paid. So this amount will have to be added. So what do? You add the increase and you subtract the decrease. Taxes payable are the same. That means you did not pay all the taxes from last year. Instead, you have more tax payables now. So what happens? You didn't pay all the taxes that you recognized as tax expense. So in this case, you have an increase in accounts payable. That's 16,000 would be added because you have an increase in liabilities. You have a decrease in income tax payable. Why? It means that simply you paid taxes, all the taxes of this year, but you also paid taxes from last year that were remaining from last year. So what happens? You paid more than you actually recorded as tax expense, right? You paid more. When you think about it as you paid more than you actually recorded, that means that your cash outflow was more than the actual one recorded. So cash outflow is more. That means their effect on net income would have decreased net income. So what do? You subtract net income. So you subtract that amount from net income. You see this table here? If you understand it and you know this table, you will get operating activities section of the statement of cash flows correct. That's the table that you will need to understand. This is the summary. When you have 3 steps in this part. First, start with all non-cash charges. Depreciation, depletion expense, amortization expense, etc. You add them back. So you add back those non-cash charges. Then you look at gains and losses. If you had recognized a gain, subtract it. If you recognize or recorded a loss, you add it back. At the end, you have changes in current assets and current liabilities. An increase in current assets, you subtract it. A decrease, you add it. For liabilities, it's the other way around. An increase will be added, a decrease will be subtracted. As simple as that. Any questions? Okay. So this part concludes operating activities. Investing activities are basically straightforward. And by the way, I know that I'm going a little bit fast. Guys, do me a favor, read the material before next Wednesday. The reason is that I'm going to actually spend more time on solving an actual statement of cash flows in class. There will be additional statement of cash flows done in the recitation sessions. Try to attend those. They will be very important for you to help you understand and to help you solve it correctly in the exam. Investing activities and financing activities. Investing activities. You look at, for example, purchases and sales of lands and of equipment, etc., and debts and stuff. So the company purchased land of 110,000. This is where did we find this information? And the additional information, right? Remember at the bottom, it said the company acquired a land by issuing 110,000 of bonds. Now, did the company pay in cash? The company paid cash. No, they did not. They paid in bonds. As a result, this is a non-cash activity, but it's significant enough that it needs to be mentioned. It will be mentioned here. This is a non-cash significant, it's a significant activity that is non-cash. It's reported at the bottom. Okay, and then we have, from the additional information, the company acquired an office building for $120,000 in cash. This is cash inflow or outflow? Outflow, so it's negative, right? You simply add it here as, basically you have here cash from investing, purchase of the building. It's minus. It's cash outflow. It decreases your net cash. So net cash will decrease by 120,000. The company purchased equipment for 25,000. They bought equipment for 25,000. So their cash outflow is 25,000. They sold equipment for 4,000. That equipment was, the cost of that equipment was 8,000. Again, you look at it from cash perspective, cash exchange. The company bought equipment for 25,000. This is cash outflow. The company paid that cash. So this amount will be deducted from net cash. What about the sale of that equipment? How much did the company actually receive in return for that? 4,000. This is the amount that the company, they sold it for 4,000. This is the amount of cash the company received. So this is the cash inflow. So as a result, you have the purchase of equipment was subtracted. Purchase of sale of equipment was deducted. What did I say? I'm sorry, it's the output. Purchase of equipment was actually a cash outflow, so it will be deducted from net cash. On the other hand, the sale of that equipment brought in money to the company, brought in cash, not money, brought in cash to the company. As a result, it's a cash inflow. This will give you net cash used by investing activities. Now, I know that it's almost time. I think we need like 1 or 2 minutes. This is very simple, the simplest of them all, I think. Common stock. I know it's a lot to handle in one lecture, but you guys need to read it, please, before next week. The increase in common stock resulted from issuance of new shares. The company issued shares for $20,000 in cash. This is cash inflow. The company is issuing stocks. As a result, they will receive cash. So this is cash inflow. It will be added. That will be plus under financing activities. Now we're looking at the financing activities here section. Okay? We have cash was issued for 20,000. This is cash inflow. And the company earned, basically the retained earnings. This is from the comparative balance sheet. There was a change in retained earnings for 116,000. Now, this is coming from net income of 145,000. We do not care about this number now because we started with that number in operating activities. That was at the beginning. But the company also paid dividends, $29,000. They paid dividends. This is cash outflow. So it will be deducted here. This is cash flows from financing activities. You add those amounts, it will give you net cash flows used by. In this case, it's used by financing activities. In this example here, it was used by investing activities. Net income, net cash provided by operating activities was 172,000. You just add those three numbers, 172 minus 141 minus 9,000, it gives you net increase in cash. This is the net change in cash. You compare it to the change in cash, it was a net increase of 22,000. You have here a net increase of 22,000. That means you did a good job. That means you got those questions in the exam correct. That means you got 25% of your final exam guaranteed. Right? So have a good weekend, everyone, and see you on